If you're a business owner that's doing over $50,000 a month and you're obsessing over minimizing your tax, it could be costing you your financial freedom. I recently had an individual reach out to me who was a business owner that was growing and scaling quite a successful business. They managed to get into the multi-seven figures, but over the time of them growing and scaling their business, their accountant had basically only provided them with advice around minimizing their tax. They were drawing about $30,000 a year from their business. They were essentially reinvesting all of the profits, and I'm going to say reinvesting because they were basically just racking up their expenses every single year in order to show no profit in their business and essentially buying things that the business frankly didn't need. Now, when we consider minimizing tax, we must understand that tax is a consequence of making money. If you are making money, you are going to pay tax. And when it comes to running a business, if you make $1 in profit, then you are typically going to pay 25 cents of that dollar in tax, which means that you have the 75 cents left over to do with as you wish. Now, of course, if you distribute that, you may pay your marginal tax rate, which could be anywhere up to about 47%, but there are other tax planning strategies that give us access to the money so it doesn't have to stay in our business, but allow us to then start using that to build wealth. On the flip side, if you're trying to minimize tax, it requires you to spend that dollar in order to save 25 cents on tax, but it still means that you're 75 cents out of pocket. So if we scale that up, would you prefer to have $75 in your hand, or would you prefer to pay $75 out? And let's scale that up again. Would you prefer to have $75,000 in your hand, or would you prefer to pay $75,000 out? Now, particularly when we're dealing with a business that's over seven figures, these numbers compound very, very quickly, and we can be talking hundreds of thousands of dollars a year in either having that in your hand, paying a fraction of it in order to keep it, or spending it on stupid stuff in order to just avoid having to pay that 25%. It's a little bit silly, isn't it? So the big thing we need to consider here is that, sure, tax sucks, but it is a consequence of making money. And when it comes to building a strategic wealth plan, the idea is about understanding what is the impact beneficially for you for paying additional tax, and what does that enable you to do? In other words, if we pay the extra tax, what strategies can we implement, and how long is it going to take us to recoup the additional tax paid as a result of the strategy? Let's use this for an example. Let's say that you run $1 million business and that business does a 20% profit margin, meaning that at the end of the year, you're going to have about $200,000 in profit available. Now, in the company level at $200,000, you're going to pay about $50,000 in tax. That sounds like it sucks, right? But you now have $150,000 available that you can use to build wealth. We use some strategic structuring that allows us to move that money out of your trading business into an investment entity, and we can utilize that as a deposit to go buy a property. $150,000 deposit should allow you to acquire a property at around about, let's say $500,000 plus costs, and you'll have some money left over. Now let's assume that that $500,000 property compounds at 10% per year. If we're buying in a good quality blue chip area, we've seen that historically many of those properties just performed at 10% a year. So for that $50,000 of extra tax that you paid in that year, by holding that investment property for just 1 year, it has increased the value of that property by $50,000. So that $500,000 property is now worth $550,000. Now here's the kicker. Your cash on cash return is significantly higher. It's in fact over 33%, because you've got $150,000, you've borrowed money from a bank to go buy a $500,000 asset. A $50,000 return on a $150,000 investment is over 30%. So this is where we go from straight away, yes, sure, we paid the extra 25% tax, but we've made 33% or more in the first year, and then that continues to compound year on year. So as a business owner, it's important that your accountant plays a pivotal role in optimizing your tax, and the operative word here is optimizing. What a good accountant and a good financial advisor should do is work with you to have a proactive plan in place. So what we do with our clients is that we work towards a financial year tax and wealth strategy. We work through your financial freedom goals, your strategic wealth plan, what milestones you need to achieve financially to keep you on track for financial freedom. That includes how much debt do you need to reduce, how much wealth do we need to accumulate, what's our expected rate of return, and ultimately what should we have at the end of the financial year in terms of net wealth and also passive income. What that allows us to then do is we work out, okay, well, as part of that strategic wealth plan, are we planning to use debt to buy property assets primarily? And does your current financial position in your business and also your available cash allow you to buy that property? It's a simple formula. Well, do you have servicing capacity and do you have enough deposit? If no, what does the profit of the business need to be by the end of the financial year in order to allow you the ability to borrow more money? We set that as a target and then we reverse engineer the KPIs to get you there. If we get there, then we show that extra income. We may pay some extra tax, but it allows us to acquire that other asset. And then we work out the break-even period, which for most of our clients, as a result of that extra tax they end up paying, it takes them a year to 18 months to recover those costs, okay? So unless we can do that, on the flip side, let's say, okay, well, we don't want to buy a property this year, and we have no need for additional leverage at the moment. So, okay, let's minimize tax this year. What can we do to keep as much of that surplus cash flow in your pocket as possible? And what is the smartest place for us to allocate that money to make sure that it's working for you? For example, for me, a big focus for me right now is acquiring other businesses. I'm fortunate enough that I've acquired over 8 figures in businesses and I use debt to fund that. So there's very little of my capital that gets tied up. And ultimately, I'm focusing on trying to build tax-effective wealth through my business group because I get access to things like the small business CGT concessions and I get access to the ability to allocate capital without having to pay any more than that 25% tax. So there's ways for me to strategically build wealth, and that's part of my plan. My focus moving forward is still to continue to diversify into property and shares and essentially make sure that I take chips off the table. So it's about making sure that tax is seen as a consequence of making money, and it is a consideration, but not the be-all and end-all of your wealth strategy. So if you feel like you've been a little bit too focused on minimizing your tax and it's come at the detriment of building your wealth, the next best thing for you to do is to jump onto wealthhealthcheck.com.au. Complete the financial performance scorecard. See how you're tracking towards financial freedom, and it'll give you some insights around the low-hanging financial fruit, the things that you should be considering optimizing in order to get on track for creating financial freedom. So go jump on wealthhealthcheck.com.au, complete the scorecard, and let's see your next best moves.